Good evening, guys. It is Monday, May 19th, 2025. This Bathrobe business. I'm George Yoganov. Got my decaf coffee, and I got the news. So today's story is mostly going to be about the U.S. credit rating. There was a downgrade from Moody's. I'm going to talk about that in a second. It's kind of the prevailing story. So I'm not really going to mention much else that's not deviating from that. The only thing I'll mention ahead of that is the Nippon Steel might finally be hammering out a deal with the Trump administration for the acquisition of U.S. Steel. So this, I'm going to share the story real quick with you guys. This is a story we've been following on this channel for a while. This happened, back in the Biden administration. I want to say at least over a year and a half ago. I believe it was late 2023, maybe early 2024, when Nippon Steel tried to buy U.S. Steel. I think originally it was about $4 billion, and the Biden administration blocked it on national security concerns. Trump also came out against it, saying it was horrible. We're letting other countries steal our jobs, blah, blah, blah. I came out and I explained why I thought this was a good idea. And it seems that we're getting closer to a deal being hammered out. So they have until the 21st. The Trump administration has until the 21st of May in order to accept this offer. But essentially, it would be that Nippon Steel invests about $4 million upfront, with an additional $14 million, and with the total in a $14 million package by 2028. So it's lucrative. It's talking about building new facilities. It's about investing in local infrastructure. I have a feeling it's going to happen. I would be very surprised if it didn't, just how aggressive the Trump administration is with deal making. But again, there's other stuff we don't see behind the curtain, such as security concerns, etc. But I would think that before, what is that, Friday, I think? Let's look that up. The 21st is Wednesday. God, I'm off. I can't do basic math, and I'm doing a business channel. It's Wednesday. So by Wednesday, we should hear results. So I think either tomorrow or Wednesday, we will hear that the Trump administration has accepted the proposal and has found it satisfactory. Okay, that's all I'm going to talk about Nippon. Let's get to the meat and potatoes. So if you haven't heard, if you look at the markets, it seems like nobody's heard. Moody's has downgraded the U.S. Credit rating from AAA to AAA to double A1. It doesn't really matter. Like each credit rating agency has their own specific way of downgrading it. But the point is, this was one of the last ones besides S&P and Fitch, which loaded it just now. This is now the second downgrade in history. So a bit of clarification. Back in 2011, I believe S&P and Fitch, one after another, downgraded the U.S. credit rating from AAA to just one step below it. It was like AAA minus. Then it never went back up. It never did. Despite the fact that we left the Great Recession, 2011 was still kind of in the afterglow of it. Even though the U.S. stock market improved, even though housing improved, even though we saw massive growth in the economy, it was never upgraded again. Then in 2011, it came through and it was downgraded one more time by both those agencies. Now Moody's has joined them as well. They've downgraded the U.S. Credit rating to, like I said, that double A1. Now, this makes things very complicated. The market hasn't actually responded, which is why Jamie Dimon came out today and made some pretty blatant accusations. He says that he believes that the S&P is going to be flat for the year. He thinks we're going to be entering a period of stagflation. He thinks a lot of people are underestimating economic spending and everything that's happening with tariffs, and that we're going to be entering very, very choppy waters. Now, I will say I'm not one to argue with Jamie Dimon. I'm a pissant compared to him and the power that he wields economically, but he has been saying this for a couple years now. It was, I believe, starting back in 2022. That he was saying, oh, dark clouds are on the horizon, things are going to get worse. And so this is kind of a narrative he's had for a while. Now, there's the old adage of if your timing is off, you're just wrong. So I believe in the long term, everything he says is grammatically correct. I just think in the short term, it's a little bit difficult to take him seriously on this point, seeing as how this has been kind of one of his talking points for a while. However, downgrading of U.S. debt is a major issue. This is going to make borrowing costs more expensive, not just for the US government, where it's affected most heavily, but also for individuals. So, for example, in this article, it underpins an incredibly good point of mortgage cost, because most mortgage rates are set off of a 10-year bond. The 30-year mortgage rate had a new high, not an all-time high, but a recent high of 7.04 on Monday, up from about the high sixes from last week. So mortgages did just get more expensive. This also does trickle down to every single capital market there is. So overall, lending and finance and everything that's entailed in there gets more expensive. It doesn't matter if you're a business or a consumer, it will go up. Anytime a credit downgrade happens, it will. Now, this also makes it more difficult to pay off US debt, because now we're going to be paying off at a higher yield, and new borrowing is going to be at a higher yield. I believe what we said, I believe 13 cents of every dollar is used on taxed dollars is spent on paying off US debt. So for every dollar you pay in taxes, I believe about 13 cents of that goes just servicing the US debt. So that's just to pay off the interest. That's not actually paying off principal. Let's actually Google this real quick, because I know we've covered it on this channel, but I forget the exact statistic. How much of your taxed dollars go to pay interest on US debt? So about 11%. I was pretty close. So 11.5% goes to paying just the interest on the US national debt. I said 13 cents. This now will become more expensive as well. And now this will be a greater component of how much your tax dollars contributes just to spending on paying off the debt. Now, there is one little silver lining that nobody seems to be talking about. And that's trade, which is kind of ironic that nobody's talking about it, seeing as how that's kind of the soup du jour. This, in turn, the downgrading of U.S. debt will actually somewhat bolster the Trump administration's trade policy. Now, it's kind of like one of those things of, well, if you're drinking poison and you have cancer, the cancer gets poisoned as well. Maybe that's a bad metaphor. I know it's a bad metaphor, but it's the best allegory I could think of as to why I think that this could have some positive effect for the Trump administration in response to trade. And here's what I mean by that. This will affect trade in two ways. The first is just the value of the US dollar. Anytime you've got a situation like this, it's instability in the market. It's essentially saying that the credit agencies don't feel that the US government is healthy enough to pay off its own debt. It obviously downgrades our credit rating and it hurts the US dollar. However, anytime you do cause deflation or pain to the US dollar, it raises exports because US currency gets more equal or lowered in comparison to other currencies. A great example is literally what happened on the day of the downgrade. So on the day of the downgrade, let me switch to this story. The Mexican peso surged above the US dollar on Monday as it gets battered by the Moody's news. So that's exactly what happened. The Mexican peso advanced 0.60 against the US dollar. That is going to help US exports because now, because of the currency difference, when you trade into US dollars, the currency exchange is lower and less of a cost to you, so you can purchase more of US manufactured products. Now, obviously, we don't manufacture to a great extent of what China does, but the U.S. does have massive exports, specifically with a lot of our biologics, especially with some of our technology, manufacturing of high-end equipment, and food. Actually, we are a major exporter of food and oil globally. So this does actually help domestic exports. Now, a second way that this helps is a little bit more intricate. One of Trump's economic theories, is if you have a trade imbalance, you are hurting yourself. That's kind of true, not the exact way that he interprets it, but kind of as an after effect of what happens. So what happens is if you have a trade imbalance, it means that you are purchasing more than you are exporting, right? That's basic. But what happens is whichever country is going to be buying from you has to have US dollars in order to purchase because it's not a clean one-to-one trade that rotates. They need US dollars. So oftentimes that comes in the form of forex trading, and oftentimes that comes in actual bond purchases. That's one of the other reasons that China purchased so many bonds was because then they're paid out in dollars. Their yields are paid out in dollars, and they use that to purchase U.S. products in order to not have to. Well, yeah, in order to be able to purchase U.S. Products, they need U.S. dollars. So that's kind of what happens. This also does incentivize the U.S. or whatever country has the stronger deficit to print more money because all of that money is going to be exported out and it doesn't actually accumulate. It also allows you to be able to have massive loans and build and build and build. You can just keep borrowing money because people need your dollars in order to purchase your products because you purchase more of theirs. So it drives your debt up. Now, it doesn't have to do that, but it is kind of one of the repercussions of if you've got a massive trade imbalance and you as the United States are purchasing a lot of product globally, you might as well print the money rather than have your currency reach majorly astronomically strong difference in comparison to other currencies, meaning that you won't be able to export as heavily. So it's almost like one of the things that will happen naturally is that the government will start to print lots of money, will start to lend out lots of money in order for it to balance its trade deficits, in order for it to be able to keep its own exports strong. That's kind of the underlying theory that Trump has, and he's not entirely wrong. He does kind of overestimate it, but that's what ends up happening. Well, what does all that mean? Well, now that means if you've got a credit rating that is worse, people will get higher yields when they purchase your bonds globally. So if you are, let's even forget US and China. Let's say that the United States is Rome, and let's say that instead of China, we're dealing with Persia. The reason I say that is it seems silly, but I just want to take politics out of it. So Rome is purchasing a lot of products from Persia. And because of that, they have a trade imbalance. Well, so what does Rome do? They print lots of bonds that will pay out lots of Roman dollars so that Persia can go in and purchase those bonds and use the yields to purchase U.S. products. Well, now, if the yield has increased because the rating of Rome has gone down astronomically, that means that they're more likely to purchase those debts because their payouts are going to be better. Now, you could say, but yeah, the payouts are better, but the country is more insolvent. It's more unstable. Yes. But at the end of the day, Rome, in this case, the United States, is still the best game in town. So even though you're still dealing with a less stable government, it's still the most stable government, relatively speaking. So you might as well purchase the bonds and get a higher yield out of it, be able to purchase more products and goods, than not purchase it, because either way, you've got to be able to get those products one way or another. So in that capacity, it does help the U.S. trade policy because now it does, again, secondarily help U.S. exports. Now, this is just a short-term benefit. It's not a long-term gain. This is obviously still a problem for the U.S. government, especially with the fact that this is now the second round of credit rating downgrade, and we've never gone back up. We continue to become more and more insolvent, and that's some of the things that not JP Morgan, but Jamie Dimon highlighted and was some of the articles we talked about today. But in the short term, it does actually help U.S. trade policy from that standpoint. So I hope that made sense. It's sometimes I feel like I can articulate these easier in my mind than I can when I'm speaking to you guys on this channel. But it's something I want you guys to consider when thinking about these things. I've always kind of taking more of a contrarian view of not just what's being reported, but what possible repercussions it could have, especially for you that, like me, are small business owners. So that's pretty much it. Those are the stories of the day. I hope you guys have a very productive Tuesday, and I'll see you guys back here tomorrow. Bye.